We're going to keep this a little bit high energy, I hope. My name is Nikhil Kalghatgi. I'm the head of CoVenture Crypto. We are a diversified asset management firm. But enough about me. If you want to talk crypto and investing into it and all that kinds of stuff, my vanity is an easy way. So just take a picture of us and hit us on Twitter. It's an easy way to get in touch with us. But I just wanted to very quickly introduce our topic and our lovely panelists. We're talking equity tokens, specifically, that vertical within security tokens, and we've got an amazing group. Just to make this very easy, please, would you introduce yourselves and in one sentence, just say your name, your title, and what you do with respect to security tokens, equity tokens.
I'm Hines, founder of Token Foundry. We are the advisory arm of Consensus. So we help projects do utility tokens, security tokens, asset-backed tokens, and non-fungible tokens.
Keough, CEO of Finova Financial. We're a venture-backed growth stage company that developed a process called the Jobs Crypto Offering, or JCO, looking to have a regulatory framework around the ICO, but in a regulatory compliant way.
Hi, I'm Ayesha Kiani. I am a managing director at Republic Crypto. It's a crowdfunding platform where companies can raise from their retail investors. As more and more token sales starts, taking place, we would see a rise of equity raises. So we're setting up platforms with that,
Great, thank you. I'm Ron Miller, and I'm the chairman of StartEngine, and we're the leading equity crowdfunding platform, and we're moving into the security token space.
There you go. So you've got principal investors, issuers, advisors, issuers, crowdfunding on the end as well. So you got kind of a good mix, I think, to talk about this. Okay, so what honestly is, this is to you, Harrison, because you're close to me. What pisses you off about the security token scenario right now, particularly around equity tokens?
Sure. I get a bit frustrated because I think people are jumping the gun. I don't believe that you could issue an equity token today and be confident that you're not putting the issuer at risk of potentially getting into regulatory gray areas or trouble down the road, or being able to be confident that they could remain in compliance with the law. So I think we saw it with utility tokens. Obviously there's a lot of money to be made and people are excited and issuing security tokens or equity tokens now. But I just think it's going to make it harder for the people who are being patient and waiting for there to be a framework for how to do this from pre-issuance to secondary trading compliantly. So that pisses me off a little bit.
So let's turn this into a little game. You just inspired me. Let's take Ron and Harrison, and you guys are going to play the downside, the bear case for equity tokens. And then Ayesha and Greg, I'd love for you to take the upside, the bull case. Okay? Are you guys willing to play this?
Yes.
Sure.
All right. Okay. Ron, hit us with it. What's the downside? Tell us how this thing goes to hell in a handbasket with respect to equity tokens.
Yeah, I think there's 3 words here, Nikhil. I think it's disgorgement, penalties, and my favorite, jail. So so to put it simply, I think to some degree what Harrison pointed out is that if you're not careful, if you're listening to the wrong people, and in some cases what appears to be right people may not be right people. In other words, there's been some bad advice given by very, very reputable law firms even that have given advice which turns out later not to be such good advice that ultimately can lead to a lot of trouble. And what happens, of course, is that when a founder, an entrepreneur that's got an idea that's going to change the world somehow engages in this process of raising capital, their job remains to be the founder that's driving their innovation forward. Raising capital is just one of those things. Now that's all good until it's not, which means that when they hit the proverbial wall of regulatory violation and they get into that thing, that is the end of their attention on any of the multitude of things that a founder typically needs to pay attention to, and instead gets completely dragged into the regulatory defense process.
So get good lawyers is the solution?
It's more than lawyers, okay? I think lawyers are a great start, but you're going to need a great team. And that team consists of, I think, people that are going to be involved in promoting the raise, that have respect for what the lawyers are saying. Because too many times, I know that if there's lawyers out here in the audience or on the panel here, you've seen where advice is given, but if you don't have the wrong culture in your organization and it's being managed or led by people who are trying to skirt the rules, I think you end up with what Harrison talked about. It looks like jumping the gun and someone's getting in trouble. And to that end, the entrepreneur's dreams just fizzle.
Greg, can you take us through the counter?
Yeah, so I think that those are definitely challenges. With that said, I think that if you look at like more mature companies, I mean, what's happened is the bar to do this has went way, way up, right? And so if you previously with an ICO, and I concur, most of those, I actually concur with the SEC, which was incredibly unpopular a year and a half ago when this industry was getting formed, that most of these things were, you know, they were either equities or they were securities. They need to be regulated. But I think if you look at, so the skill set was a white paper and some guys in a garage figuring out a clever idea, right? So that was it. So that barrier is pretty low. I think you're moving in the security token space to a much higher barrier, but also a much greater reward for the investor. And so I think if you look at it, great point, you need to understand regulation, compliance. You actually probably have to have departments in your company that do that. So Finova, for example, we were a good case for this because we've raised over $100 million in venture capital from Silicon Valley. 500 Startups was an early investor. We have private equity money. The CoVenture actually is an investor. And we've been operating for 2.5 years, and basically we are a lender. So we're an online lender for kind of the unbanked. And so as that, we have lending licenses. We have to file reports on those lending licenses. So you have to have an infrastructure in place, I think, to do this that's a lot more advanced. With that said, so that's the downside from an entrepreneur's perspective. The upside is, I think there's an incredible appetite, and this is, as we all here believe, a multi-trillion-dollar change, and we are very, very much at the very beginning of this. But it is a much higher bar than it used to be, but I see that as a good thing for investors and funds, and those with a fiduciary responsibility to invest.
Okay, so Ayesha, if we're not going to jail anymore, all right, we got good lawyers, got it, we've got good culture. Like you said, it comes from the top, comes from inside. We know the team's on a good page. We've got a good idea. We got some good funding. Take us through the next steps over the next 2 or 3 years through to the $1 trillion market. What has to happen? What are the step functions, the big marquee events that one or two marquee events that have to happen that you think would get us to $1 trillion?
So I think in my personal opinion, asset tokens will take over stocks. And the reason I say that is because from a Republic's perspective, right? The company has been around for 2 years. Our equity side, you know, any good company can come and raise from their crowd. And under a Reg CF offering, you can do $1.07 million. It may increase in a couple of months down the lane. We've used the same model for blockchain and crypto companies. With A+ coming into play, you know, a huge play just comes into play. Now the thing is, the same people that are investing in the company, they will have, you know, like an asset, they would have the ownership into each and every company. That kind of gives the companies a lot more liquidity, you know, a lot more capital to bank on. The other thing is, no offense to any VCs right here, but, you know, raising from the crowd or raising from your general masses kind of, you know, goes against the traditional VC model, right? So that's where we think, you know, asset tokenization could be a greater thing for all the emerging companies. You know, different ATS are coming into play, which will let a lot of different security tokens, you know, just to be tradable. The other thing is interoperability. You know, me giving you a token for your Ferrari is a lot more easier than me signing 300 different forms, waiting 3 months for the SEC approval to, you know, for this stock's liquidation to make sure, you know, the funds are transferred. So I think that's where the huge upside is for the asset tokenization.
So do you think, just taking that and bringing it to the traditional world, does that mean there's some sort of mixture of these assets on a single platform? Like, do you see tokenization of public equity being traded on a security token exchange?
So currently right now on Republic's platform, there is a healthcare company that has been around for almost 5 years or so, and they decided to go blockchain route. And the first thing that they did was...
Is it a publicly traded company or is it a private company?
It's not a publicly traded company, it's private, but they've issued tokens. Labdoor is the company's name on our platform. They're raising as test. They wanted to give it back to the community. They had a huge community. They wanted to issue it back as tokens. They do have an entire process set up on how they're looking to implement blockchain into their multivitamin things. So yes, we've started looking into it. We will help it as more and more dialogue comes into play, but yeah.
So I like playing the good guy, bad guy sort of thing, and I'll be the bad guy because it's a lot easier for these wonderful panelists to be the good guy. So is there just this pile of liquidity at the end of the rainbow when we want to tokenize this equity?
Yeah.
I would
Harrison,
say...
you're about to jump in there.
I would say I'm skeptical. I mean, a tokenized equity or securities are just a digital representation of the underlying asset. I think people are a bit, let's say, overconfident in, at the end of the day, you're still raising money for an investment opportunity or something. There's got to be someone who wants it. Do I think a token adding easier liquidity to get in and out of these positions and not be so locked in creates or makes them more appealing? Yes, but there's a lot of groups out there or projects that say they're going to raise 100 million or are going to do all sorts of crazy things, and it's very easy to claim you're going to go and raise that money. I'm skeptical that any meaningful percentage of those projects who hear the word token and then immediately get irrational about their terms or their valuation or how much money they need, I think they're going to be in for a disappointing track.
Okay, so I'm going to marry the 2 points that were made, and I need you guys to help me with that. So the first point is that there's this $1 trillion opportunity over there, and that there's a whole bunch of liquidity if we can just convince people to educate themselves, and we can actually transact. For example, if you can have a smart contract that allows you that you can trust very easily, then all of a sudden there's people that can easily buy that Ferrari or a fraction of that Ferrari, as an example. And even further to that point, I've got several funds. I used to be a VC at SoftBank for many years. I can tell you that companies are staying private longer. We've had the same 10 plus 1 plus 1 fund structure in private equity for, 40, 50 years. I don't actually know when it was invented, but it's been a long time. And that's not great from a fundraising perspective. Those two things are obviously at tension with each other. So clearly, an alternative would be better. It would be fantastic if the entire world of private equity could sell its shares of its funds in secondaries much easier than the very nascent market that exists today for that. So there's a lot of incentive for people to want it, to create an environment for people to want to buy these sorts of things. So how do we get from here, knowing there's a problem, knowing people are incentivized, to where there is people that are educated, where we have trust in selling these secondaries, and don't have to go through 300 pages and 1.5 years of soliciting with lawyers? How do we get there?
Well, I think the end token to Harrison's point is if you're building a token, it doesn't have any, you have to know why you're doing it, right? So in the case of Finova, we have a very high yield business, and it's also secured by assets, right? So we lend against cars at a very good ratio, and we have a very, very good return, and this has been proven over multiple years. And so my belief is, and this has been validated, globally, there's a high appetite for 1, high yield, 2, US based, and 3, asset-backed. That is the exact reason why Finova is doing this process that we're doing. So it's very, very specific. So I know people in Japan who have 0 yield would love to probably get out of their currency, get into a different country, but also have a dividend going out. And by the way, the dividend can come daily, weekly, et cetera, off assets secured in the United States at a good LTV. That's the reason we're doing it. But I think, to your point, every single person who's doing this, it's not just you click on equity token to whatever it is. there must be some reason, right? Somebody would buy it, in my opinion. And
I think, so yeah, to his point, we're currently looking into a company that is tokenizing a real estate investment fund. Now, personally, would I love to jump on it? Absolutely. Why won't I love to hold tokens to 10 different buildings around New York City, right? Because, you know, if the company is providing me that, I would do it. I think to Harrison's point, the notion of like, you know, some really crappy projects, raising $100 million and not seeing the end of daylight, I think that era has kind of ended.
Yeah,
now we've started seeing some really credible companies using blockchain and tokenization to their own advantage, and you know, to build out the future financial infrastructures. You know, every industry goes through a bad period and a good period. I'm not saying that there won't be any shitty projects out there. There will be probably, but I think we've crossed that path.
Okay, without shilling our own portfolios, what is the equity token project that you are most excited about today?
So for instance, Test Labdoor, the one that I mentioned, it's currently raising on Republic. Super excited for them. It's our first case on how a company that has, you know, been around for a while decided to go blockchain and decided to give it back to the community.
All right,
Mine, without a doubt, would be T0. And the reason why I say that is, number one, it's domestic, and secondly, they did it compliant with the US security regulations. And that is what, when I look at that raise, that one is the example in my book about how it can be done consistent with the rules and still generate an awful lot of investment and do so in the right way.
Wow. And and as far as the advisor in the room, you've looked at, I mean, how many projects have you created now at Token Foundry or working on?
Like 15 right now.
15, okay. And I know you can't spill the beans on a lot of them, but maybe you can talk about some of them in abstract ideas or other companies you've seen. What are some of the equity token concepts that you think will be, you know, will level up the entire industry?
Sure. Well, I want to make a point that I think there's a very clear distinction between utility or consumer tokens that might power a new decentralized network and security or equity tokens. So equity tokens are nothing more than a digital representation of an underlying share or security in a company. But what's really fascinating and what we are starting to do and look into is they don't necessarily have to be plain vanilla equity tokens. You could have hybrid tokens. You can start to give these equity tokens use. So they are a security. They do represent equity in a company, but maybe they could be converted into something else, like a membership seat on an exchange, or maybe they could have different functionality. What I think is really interesting is now with tokens, you don't have to just limit it to straight equity. Like you could imagine a day where everything on a company's balance sheet is tokenized. So maybe like, I don't know, well, this could get really deep, so I'll leave it there, but I'm excited about hybrid equity tokens that aren't just plain vanilla equity tokens. They could have use, they could have different like functions, but also getting deeper into how do you now tokenize different assets and things on a company's balance sheet.
I'm really intrigued by this idea. So can we, I know this is like not the next phase, it's probably the phase after that we're talking about, but let's allow our imaginations to run wild for a moment. Let's say, you know, we get to, you know, second base and there's a tokenization, as Ayesha mentioned, of traditional assets, which I personally believe is what is going to drive traditional investors onto this entire platform. But then all of a sudden you're going to have tokenization of things that have never been securities previously, right? They're almost like sub-securities, elements of a balance sheet. What would be an example? Can you just enlighten us, give us a few ideas of what that could look like? Is it programmable balance sheets? Or is it something else that I can't even imagine?
Well, I mean, I just think when you think about a token, it can represent anything. So maybe it's a business that has several business lines. You could tokenize those individual business lines if you want. Maybe if there's a business line that needs a very like capital intensive like investment into hardware or infrastructure, like you could potentially just tokenize that underlying infrastructure or hardware, or like some projects that are launching tokens early are doing things like rev share. So maybe you don't have to just get rev share in an entire company. Maybe you could start to break it down into individual business lines. So if you just want to speculate that Google's ad business is going to accelerate, you don't really care about the other things they're doing, why couldn't you tokenize just that? I think you can, and I think that's where things will move eventually.
So what do you think, this goes for Ron in particular, what do you think it will take for traditional early stage investors, like yourself and Ayesha to an extent, to accept tokens and replace them instead of shares? To overcome, instead of just investing in both, to say, you know what, we don't even need shares anymore, we just want to do token investing.
Well, we really believe that the existing regulatory scheme that is out there is fully capable of supporting the token issuance instead of the shares, right? Ready to go now. That's a really, really important thing. I think also, though, we'd be remiss here, Nikhil, if we didn't really talk about, I think, the practical realities. Like a lot of times on these panels, I sometimes feel like sometimes we're often talking in our own box. Mm-hmm. The biggest problem we have is lack of awareness. That's the frustration, right? Without awareness of this new means of raising capital, we essentially are going to be stuck. And so it's less about the technical capabilities and more about where the market will finally accept these things, or at least know that there is such an opportunity. And I would tell you today we're when you look at the Jobs Act that was passed in 2012, and even today, I flew on an airplane last month with a guy sitting next to me. He was a computer engineer, graduated UCLA, works in the Valley. And when he said, he told me what he did, I asked what I did, and I said, well, I'm in the equity crowdfunding business. He said, wow, that's a really neat idea. And I thought, oh, God, where have you been? And this is a guy working in the Valley, let alone, some of my friends that I grew up with in suburban Detroit, for example. If you go into the Midwest and you start talking about, cryptocurrencies, they say, what's that?
Right.
Some of them have never even heard of it. So you have to keep in mind there's this awareness thing. And I think that might be one of the biggest frustrations I have in looking at it, is that this is what I call a getting ready thing, right? So as a founder, if you're looking to raise capital in this way, it is absolutely essential that you find the way to do this and do this compliantly. That is critical, but that is completely insufficient. What's gonna make the difference is whether or not you have a powerful message that you can take to the marketplace. And second, how are you going to distribute that message? Who are you going to talk to? A lot of people think just because you are compliantly prepared to issue, that means you'll be successful. And actually, I think that while that may have been true in 2017 with some of these ICOs, just based on the hype, when you think about this broader market to hit the T potential, the trillion-dollar potential, multi-trillion-dollar potential this industry represents, it's got to be, people have to be aware. And it has to be more than just the 8% of the population that are accredited investors. Mm-hmm. We've got to figure out how we're going to get the other 92%. And I think the key to that, by the way, is us early adopters doing so compliantly, because if we get ourselves in trouble in the early stages, it's going to look like a lot like last year, where there were so many, sort of issuances that maybe shouldn't have happened, that now sort of bear a bad name for the rest of us.
So raise your hand, audience and panelists, if you have considered tokenizing the equity of your business. There you go.
Right.
So
I know you have.
We're doing it, yeah.
All right.
Yeah, we're doing it too.
You have?
Yes, we're in the process.
You're in the process? You have considered, but you've not done it? Why have you not done it?
I just believe that anyone who's actually issuing a security token right now will not be able to remain in compliance.
Wow. Wow. So you just called out several hands in the audience, including lovely Greg right next to you.
Yeah,
Greg, can you
agree?
Nikhil, so one thing I'll just add to one thing, and I'm so sure Ron is probably on the same end. We've seen from projects, and aside from Republic tokenizing itself or StartEngine token, we've seen so much demand for this that we recently had to come up. So Republic's debt agreement, which is our token DPA, our version of SAFT, we had to create an entire debt agreement called as safest being equity tokenized for companies to take a look into it, because this is becoming the next big thing. It is. And before the projects were most of just looking into the idea, now they're just directly approaching us. Look, we want to issue equity. How can we do it using Republic? And in past 1 month alone, because our CEO is an attorney, I'm an attorney myself, and 4 of our other internal counsel team, one is sitting in the audience, had to come up with the agreement just to make sure that we can facilitate these sales going forward.
I want to give you the mic in a second. I just want to tee you up. Coming back to this point of no one is doing it compliant today, which is an astounding statement, I have to say. Greg, what's the counter? You created your own standard.
So the counter is so if you look at the initial skill set that was out there in the ICO market, you had nobody who had ever run a publicly traded company. It wasn't the same skill set that you need to get this done, right? So before I did this gig, I was a CEO for a joint venture between MasterCard and Telefonica running their global mobile financial services. So basically I reported up to 2 of the biggest publicly traded companies in the world. So, and my co-founders also was the head of regulation and compliance there. So he came, we founded Finova. And so I think that you're right, it is fraught with peril. I totally agree with that. And I'll give you a great example. If you put in your document equity tokens to the SEC, you're going to have a problem if you're not calling them digital equity securities. So there's a lot of very fine nuances that, we've been doing this for about 1.5 years, building this out, that are there that you need to do, that you also, by the way, you can have 2 approaches. You can do the ICO approach, which is I try to do it and see if I get away with it, or you can actually go, the way regulation is really done. I mean, when I was running the other gig, we wrote the mobile money laws in Peru. You meet with the regulators. You tell them, hey, I'm thinking of doing this. What do you think?
I think to Harrison's point, what he said was that the downline compliance, not just the issuance being in compliance, but also what does that mean to a founder who then tokenizes their company and raises capital? There's CrowdCheck, Sarah Hanks from CrowdCheck. She's a highly experienced securities lawyer, has one of the best reputations in the industry. It's $25,000 a year is about what she charges, average fee for Reg A plus downline compliance. $25,000 a year. So if somebody raises 10 million, 5 million, 25 million, whatever that number is, that $25,000 a year to get one of the best attorneys in the industry to assure downline compliance. Now that doesn't include the audit, right? You're going to need an audit as well, but the legal work alone. And she's going to say that legal work was done consistent with SEC rules. And so if you can off that for $25,000, I would never try it myself. And I think, counter to what Harrison was saying, actually, it's quite simple. From a founder's perspective, I would say, wow, $25,000 a year, and you make sure you get it right. So I do think that there's potential to keep the downline compliance correct.
Well, one of these challenges with the documents and stuff going back to is the reason we did this whole JCO thing, right? So we've spent a lot of money.
What's JCO?
So JCO, we termed it because we were at this the beginning of last year. We were working on this stuff, and we just didn't want to be associated with ICOs. Right. So we developed a new name for it called a jobs crypto offering, and the idea was how do you use regulatory framework that exists to both put your to tokenize equity and then actually have it traded. And so I think that one of the things that came out of that was, one, we spent a lot of money on it, which is fine, but then we're going to actually open source all these documents. And so we have Jeremy Gardner, he's with us as an investor advisor. We have David Namdar from Galaxy, et cetera. So the whole idea, because we've just all identified a complexity here, which is why should we all spend for the same legal documents 100 times? So these documents we've done, we plan to open source once Finova, those are the train tracks. Finova is merely a train, but we'd like other trains to go down the tracks. So we'll be open sourcing those documents, which hopefully will mitigate a little bit the costs associated with somebody else looking to do this in a compliant manner from a startup perspective.
I would just say, a few things. So I agree to the point where the market needs to be better educated, because it's shocking to me that even most people who work in the industry don't understand that tokens are different than cryptocurrency and that there are different types of tokens. So there was no framework, there was no regulatory guidance on how to issue and sell a utility token, which is a clear non-security, You wouldn't follow securities framework to issue a utility token because it's not a security, so you shouldn't follow securities framework. Now for equity or security tokens, there is a very clear framework. It's existed for years. Everyone knows how to use it. It's very clear how you issue a security and how you deal with things like settlement, with clearing, with custody. What constitutes good control? How do you deal with issues like escheatment? How can you remain compliant if you are issuing a token to anonymous wallets and cannot keep track of the ownership of your security? You can't today.
But isn't that where KYC AML comes in?
Those aren't built into the smart contracts for people today that are issuing equity tokens to people's wallets.
But then
you cannot
that's
remain
today.
compliant.
We're talking about 2 to 3 years.
But I made a specific comment that you cannot issue an equity token today and
but
remain
most of these
compliant.
agreements
I'm gonna. This is exactly what I wanted everyone to see. The point is, it's in flux. It's changing. It's really hard. Really hard for issuers. Really hard for buyers. And to Ron's point, make sure you got good lawyers. It's definitely needed. That is all the time that we have for right now. I just want to say thank you to the STA staff, the unsung heroes, for organizing a lot of this. Steve McKeon, the 4 panelists. Thank you so much. Let's give them a round of applause.